Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Carnival's stock has been on a nice tear in 2023, but is the future really bright for this company? There are three red flags that I think investors really need to think about. That's what I want to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to dig right into the numbers. The first thing to look at with Carnival is the company's debt load. And I have two numbers here. One is the total debt for Carnival, over $33 billion, and the interest expense. That at this point is coming to $1.8 billion annually just to service the debt. Now, there's a couple of things going on with the interest expense side of things. One, when Carnival was really in trouble during the pandemic, they had to shut down a lot of their cruises. Investors who were giving the company debt were demanding very high interest rates. So that's why you see that spike in interest rates there. But at the same time, over the past year, interest rates have actually gone up. So I wouldn't see there being any relief from an expense standpoint. I would actually see in the future that interest expenses are probably going to increase. That will put pressure on the company's income statement and balance sheet even further. If they don't have enough money from operations to pay for interest expenses, there's just no way to get out of this debt hole. The second thing that I want to highlight actually doesn't come from Carnival at all. It actually comes from data that we have about the US economy. A couple of charts that I'm going to show here. The first is consumer debt service as a percentage of personal income. We've had trends like incomes rising over the past couple of years as people are making more money, can demand more money from jobs, but rising debt loads have kind of offset that. So people are actually spending just as much of their income today on debt as they were before the pandemic began. And that is actually up pretty sharply from when we exited the Great Recession. Another way to look at this is consumer loans. And this is credit cards and other revolving debt. And this one, I think, is the really shocking one that we should all be really keeping an eye on. You can see that there's a trend higher from 2014 to the moment that the pandemic starts. And that's when you start to get people spending less on discretionary spending because we were under lockdown and there were stimulus checks. So there was actually a savings rate in the US. That's why there's this sharp dip in credit card debt and other revolving debt. But starting in 2021, things start to increase, and we are now on or maybe even past the trend line before the pandemic. So is there more appetite and ability for people to take on more debt to do things like go on a vacation? That is something that I really have a question about, and I think could be really a headwind, especially as things like student loan repayments start later this summer. The final red flag, again, is a little bit more macro, but is this the best operating conditions that Carnival is going to be able to see in the next few years? Unemployment is extremely low. We're coming out of a time where people had savings. The stock market is high. The historical trend would be that we're going to have some sort of traditional recession sometime in the near future. If that happens, then discretionary spending on things like cruises is going to decline. That will reduce demand. And that's where you see problems with things like the Carnival's free cash flow, negative free cash flow of $2.4 billion over the past year. Again, combine the spending trends that we have from consumers with the debt that Carnival has and the negative free cash flow. If this is the best operating conditions that Carnival is going to have, then there's nowhere to go but down from here. So these are three red flags that I think investors should really think about with Carnival. It's not a stock that I'm buying right now. I just think it's too highly valued. Now I want to see a business like this be able to generate net income and free cash flow. But what do you think? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.